Now, here's a number that should get your attention: $1.08. That is how much more you paid per gallon of gas on April 9th compared to just 1 month ago. The national average hit $4.16, a level we haven't seen since August of 2022. Now, that number doesn't just hurt at the pump, it shows up in your CPI report, your consumer sentiment data, your restaurant tenants' traffic numbers, and ultimately in the confidence level of every buyer and seller of commercial real estate right now. This week, we got 4 major data releases that all tell the same story, and I want to walk you through every one of them because if you own a strip center or you're thinking about buying or selling one, you need to understand what's actually happening in the economy your tenants are operating in. I'm Ray Kang. This is Retail Weekend Wrap Up. Let's get into it. The Bureau of Labor Statistics released the March 2026 Consumer Price Index, and the headline number, 3.3% annual inflation, jumped from 2.4% in February. That is the highest annual rate since April of 2024. And here's why. Gasoline surged 21.2% in a single month. That one category accounted for nearly 3/4 of the entire monthly CPI increase. Now, here's what matters. Strip out food and energy, and core inflation came in at just 0.2% for the month and 2.6% year over year. That's actually a tenth of a point below forecasts. Shelter inflation fell to 3.0% annually, and that's its lowest since August of 2021. Food prices were flat for the month. So what this CPI report is telling us is the underlying economy is not on fire. The energy shock from the Iran conflict is the driver here, not a broad-based inflation reacceleration, at least not yet. But here's what strip center owners need to pay attention to. Real average hourly earnings fell 0.6% for the month. Wages went up 0.2%. Prices went up 0.9%. That means your tenants' customers are falling behind. Their paychecks buy less today than they did in February. That spending squeeze is the invisible pressure on your tenant base right now. The March jobs report came out on April 3rd. Non-farm payrolls added 178,000 jobs, nearly 3 times the 59,000 consensus forecast. On the surface, that looks strong, but context matters. February was revised down to a loss of 130,000 jobs. The 3-month average sits around 68,000 per month, and the unemployment rate dipped to 4.3%. Largely because 396,000 people left the labor force, not because employment surged. Healthcare and social assistance carried most of the weight again. Long-term unemployment, people out of work 27 weeks or more, is up 322,000 over the past year. The labor participation rate at 61.9% is near its lowest since 2021. So for strip center investors, your tenants' customers still have jobs. That's real. But the labor market is running at stall speed. Job creation just enough to hold the line, not enough to fuel a spending surge. This is not the backdrop for aggressive consumer expansion. It's a backdrop for cautious, value-oriented spending behavior, and your tenant mix should reflect that. Also released the University of Michigan's preliminary consumer sentiment index for April, and it came in at 47.6. That is a record low. It is below the previous all-time low of 51.7, set during the 1980 energy crisis. It is 11% below last month and 9% below a year ago. 1-year inflation expectations jumped a full percentage point from 3.8% in March to 4.8% in April. That is the largest single-month jump since April 2025. Long-run inflation expectations rose to 3.4%, the highest since November 2025. 1-year business condition expectations fell 20%. Assessments of personal finances dropped 11%. Consumers specifically cited the Iran conflict as driving unfavorable economic changes. Here's something to think about. 98% of these survey interviews were completed before the April 7th ceasefire announcement. So this data primarily reflects conditions before that news broke. The Michigan survey director herself noted that sentiment will likely improve once consumers gain confidence that the supply disruptions have ended and gas prices have moderated. That's the potential turning point. But it hasn't happened yet, and the ceasefire is fragile. Crude oil is still trading near 2022 highs. We are watching, watching carefully. The AAA national average hit $4.16 per gallon on April 9th. That's up $1.08 from just 1 month ago, the fastest 1 month jump in years. The last time we were at this price level was early August 2022. For context, higher fuel costs function as a regressive tax. Lower and middle income households spend a larger percentage of their income on gasoline. And when gas goes up $1.08 in a month, that's roughly $15 to $20 a tank fill up disappearing from discretionary spending. The 10-year Treasury closed at 4.31% on Friday. The Fed held rates at its March meeting, and the market is pricing virtually no cuts through year end. Fed Chair Powell signaled a wait and see approach. The energy driven inflation spike may be temporary, but the Fed needs to see it confirmed before moving. For strip center investors and owners, here's a practical translation. If you're financing or refinancing, commercial mortgage rates are starting in the mid 5% range, with the 10-year as the base and lenders adding 150 to 250 basis points on top. And that math hasn't changed meaningfully from last month. The environment remains tight. Patience is still required. Restaurants, quick service, fast casual, casual dining are the most common tenant category in strip centers. If you own a strip center, you almost certainly have at least one food service tenant. And right now, the restaurant industry is going through a bifurcation unlike anything we've seen outside of a recession. Consumer confidence has declined 14 index points since 2023. Research from Revenue Management Solutions shows that a 10-point drop in consumer confidence correlates with a 0.5 to 2% drop in restaurant traffic within 2 months. Only about a third of restaurant brands tracked by Black Box Intelligence posted positive comparable sales in 2025. So this isn't a uniform pullback. The spread between winners and losers is staggering. In Q3 2025, Restaurant Dive tracked same-store sales performance across major public chains. Chili's posted 21% comparable sales growth. Sweetgreen fell 9.5%, a 31-point spread between the top and bottom performer in the same quarter. The dividing line, value. Chili's won by going aggressively after the $10 to $12 price point, competing directly with QSR on cost while maintaining a sit-down experience. The value-oriented operators are taking share, and the premium price concepts are somewhat losing it. Here's something directly relevant to our Texas markets. Mexican and Latin limited service restaurant concepts are the standard growth category right now. Santiago and Company's transaction data showed purchase frequency at Mexican LSR chains increased more on a year-over-year basis than any other limited service category. Cava continues to show strong performance, and Mexican fast casual formats broadly are outperforming. If you're evaluating a tenant in your center or if you have a vacancy to fill, concepts in this category are operating from a position of relative strength right now. One finding from McKinsey's restaurant research deserves some attention. When consumers plan to reduce restaurant spending, most do not switch to cheaper restaurants. They stay loyal to their usual places, but they use more promotions, order fewer items, or choose less expensive menu options. The implications for your tenants: the operators who are quietly cutting portion sizes or reducing ingredient quality to protect margins are risking the breaking point the moment a cost-conscious customer walks out and doesn't come back. As a strip center owner, the question to ask your restaurant tenants is not just, are you paying rent? It's, what is your value proposition right now? And are you executing it? So here's the through line of everything we've covered today. Consumers are paying an involuntary tax at the gas pump. $1.08 more per gallon than last month means real money leaving discretionary spending. That flows directly to your tenants' traffic counts and their ticket sizes. The tenants most exposed to this are discretionary retail and full price casual dining. The tenants most insulated are service businesses like nail salons, insurance, tax prep, medical, and value oriented food service. If your center skews towards services and value, you are in a more defensible position right now than you might realize. Now, the rate environment is not getting easier. The Fed is not cutting. The 10-year is at 4.31%. Commercial mortgage rates are in the mid 5% range at best, and owners who have been waiting for rates to fall meaningfully before making a decision to buy, sell, or refinance are operating in an environment where that relief is not visible on the near term horizon. The practical implication: decisions need to be evaluated at today's rates. So let's bring this all together. This week gave us four major data releases: CPI at 3.3%, driven by an energy shock, a jobs report that looks better than it is on a deeper read, consumer sentiment at an all time record low of 47.6, and gas prices averaging at $4.16 a gallon, up over a dollar in a month. The ceasefire is a potential turning point, but it's fragile. Crude oil is still elevated, the Fed is not moving, and the consumer doesn't feel better yet. What does this all mean if you own a strip center? Know your tenant mix. Understand which of your tenants are operating in the value lane, because that's where consumers are going right now. And evaluate any financial decisions, refinancing, sale timing, lease renewals, against today's real cost of capital, not an optimistic future one. If you found this valuable, subscribe to the newsletter at stripcenteriq.com for the written version of everything we covered today, plus the full source list. And if you have a strip center in Texas, and if you want to talk through what any of this means for your specific property, please feel free to reach out. You'll find my contact information in the description. I'm Ray Kang, and I'll see you next weekend.